This week, the stock market fell, and in this podcast clip, we have billionaires issuing warnings on the economy. As an investor in the markets, I found this a must watch.
All right, listen, we got to talk about markets. We got Brad here, our fifth bestie. Stock market pulling back, as Chamath just said. Hey, we're going to be risk off, and we have been getting a lot of data, a lot of hand wringing going on, Brad. GDP growth, hey, maybe that's mostly due to AI. The unemployment rate's ticking up, inflation's ticking up. Lots of concerning signs. Help us make sense of this, Brad.
I think, Chamath teed this up perfectly, which is, let's rewind the clock a little bit to April of this year. I think on an intraday basis, the NASDAQ was down 20% year to date. In April, we're now up 20%. So a 40% move higher in a few months. Same with the S&P. I think it was down over 10%. Now it's up 14% on the year. So we've had some pretty massive moves. And I think you have to, reflect on where we are, and we used to do this on market checks when I was on. And you say, where is altimeter? And so early in the year when we were worried about tariffs, altimeter was positioned small, right? By May, we thought they would land the plane with the best consensus on trade. We'd get the big, beautiful bill passed. And we went to kind of extra large positioning, and we've been there most of the year. And so now we're back to kind of Chamath just nailed it. We're back to kind of medium, small positioning in the market. And I'll walk through a couple of slides as to the reasoning for that. Maybe we can kick it around a little bit. The first one is just there's growing signs, the consumer is pulling back. And you heard it out of Chipotle, you heard it out of Kava, you heard it out of NCL, you heard it out of JetBlue. And, the nature of it is we have this two-tier economy. The low-end consumer is faltering, the higher-end consumer is hanging in there, but the consumer thing's making people nervous. Now, compounding that is U.S. credit card delinquencies are now back to 2009 levels, right? Uh-oh. And so you have, consumer cracking a little bit, delinquencies, and now we're seeing regional banks roll over, et cetera. We're seeing the credit markets beginning to crack a little bit, credit spreads blowing out a little bit. And then if you go to this next slide, this goes to what Sachs has talked a lot about on this pod, that we're still in highly restrictive territory when you look at the 10-year tips. The Fed is still got the market tight because they're seeing the market at all-time highs. They're seeing AI stocks rip. But under the surface, I think there's a lot of concern and question about what's going on. The good news about this is we still have firepower. So what's gone on in this earnings season? This next slide, basically earnings have come in really strong. So we have 70% of companies that are beating. They're beating by wide margins, in earnings. But if you look at the forecast, basically earnings have come in about 11% higher than last year. And the stocks are up about 13 or 14%. But the real question is as we roll into next year. And so, Scott Besson on the one hand is saying, listen, in Q1, we're going to have some big tax refunds because of no tax on tips, no tax on overtime. And he thinks that'll give it a boost. But clearly you hear them pounding the table that we need to get rates down. I tend to agree. The low-end consumer who pays a lot on their credit cards, on their car loan, et cetera, is clearly hurting. We see these layoffs. These layoffs are hurting some of these people as well. And so when you look at the multiples of the market, how do we look at it from an altimeter perspective? We still believe that owning all of compute like we have for 3 years and this AI trade has room to run. But there, obviously, multiples have come up a lot. I talked about a 40% move from the bottom this year. And so you can just take your position size and make it a little bit smaller. So in the world of less or more, I think Chamath's exactly right. There's a pause as we head in over the course of the next couple months, reflected by the stuff that we're doing. But I do think the economy is set up as we head into next year.
There's been a total decoupling. It used to be the case that as goes Main Street, so goes Wall Street, or vice versa. The unfortunate reality is that there's a handful of companies that have bids that are totally speculative and well into the future, but they are so well bid and they're so highly valued that they drag the entire indices forward, even though underneath the waterline, you're leaving 493 companies behind. And the reality is that those companies that more accurately reflect what's happening to middle-income America are not doing so well. And so we need to find some visible wins in the domestic policy arena. I think that that's what we need now. Because if you think of each year of a presidency as an act in three parts, I think Act 1 was tariffs. I think Act 2 has been foreign policy. And now it's an opportunity for Act 3 to refocus on domestic earnings and the domestic wealth effect of middle-income Americans. I think that's what has to happen. And there's a lot of clever ways, by the way, that we can do this. But I think the really interesting opportunity for us is to use the money that's been committed by all of these countries as part of their trade negotiations. Like if you add up the money that was committed from Japan to South Korea to the Middle Eastern countries, you're talking trillions of dollars. I think it's like 3.2 trillion is the number. So it's an enormous amount of capital that can improve the state of earnings of the middle class. And I think we need to figure out a way to more aggressively put that money to work now. I think that that's what needs to happen, I think. If you look at some of these other markets, it's really incredible. Bitcoin is about to break through 100,000 to the downside, which I think is a psychological barrier that probably has another 5 or 10% more to run. There's a dispersion happening in the Mag 7 as of this past quarter earnings. So I think all of it has to get sorted out.
The Nasdaq is up 40% from April lows, but is that masking a brutal reality? A handful of AI companies are dragging indices higher, while the other 490 stocks are reflecting middle-class America being left behind. Meanwhile, credit card delinquencies hit 2009 crisis levels as the Fed keeps rates high. It appears markets have decoupled, where a handful of highly valued AI companies drag indices up 40%, while the rest of the 490 companies that actually reflect what's happening with middle-income America are being left behind, which could be potentially creating a dangerous two-tier economy. This does seem like one of the most distorted markets we've seen in a long time. The S&P 500 and Nasdaq look healthy, massively on the year, but those gains are concentrated in maybe 7-10 mega cap tech companies. Strip those out and you'd see a very different picture of what's actually happening in the economy. When Nvidia, Microsoft, Google, Meta, and Amazon represent 25 to 30% of the index weighting, they can pull up the entire market even if everything else is declining. The math works because those companies are so large that their gains overwhelm losses elsewhere. This can create a dangerous illusion. Politicians and media outlets can look at markets at all-time highs and assume the economy is strong. Investors see indices up 20% and think everything is fine. But there could be a reality underneath which is much weaker. The 493 companies not named Nvidia or Microsoft are reflecting economic conditions that they're experiencing, and there's data suggesting they are deteriorating. AI companies serve global enterprise customers with massive budgets. Their revenue isn't dependent on whether middle-class America can afford their credit card bills. But retailers, restaurants, regional banks, consumer goods companies, those businesses directly reflect consumer health, and it appears they might be struggling. The two-tier dynamic means traditional market signals are broken. Usually when markets rally strongly, it signals broader economic strength. Not anymore. You can have markets at all-time highs, while the middle class is under severe financial stress. And that middle class stress is showing up in the credit card data. Credit card delinquencies are back to 2009 crisis levels, and the low-end consumer is faltering, but the Fed's keeping rates highly restrictive, which means interest rates are still high, because they're looking at all-time high markets and ripping AI stocks instead of the credit stress building underneath. Brad Gersner shared the data point that US credit card delinquencies are now back to 2009 levels, while consumers are pulling back, with evidence from the likes of Chipotle, Starbucks, and JetBlue. This 2009 level of delinquencies is a massive red flag. That was the financial crisis territory when unemployment was spiking and the economy was in freefall. We're seeing similar stress now despite strong headline numbers because interest rates are crushing anyone carrying debt. High-income consumers with paid-off houses and investment portfolios are fine. They're benefiting from higher interest rates on savings and portfolios, which are now up 20%. But low and middle income consumers carrying credit card debt at 20% interest rates, car loans, struggling with rent increases, they're getting destroyed. Consumer companies like Chipotle, Starbucks, and JetBlue are calling out customer weakness, and they aren't just budget retailers, they're mid-tier brands. If they're seeing a pullback, it likely signals consumer stress has moved beyond just the lowest income tiers. It's creeping up the economic distribution. The Fed does have a real dilemma. They look at the S&P 500 at all-time highs, unemployment still relatively low, and think we can't cut rates aggressively or we'll overheat the economy and could see the return of inflation. But all of that might be masking a serious problem because credit card delinquencies don't spike to crisis levels in a healthy economy. So the Fed is stuck between needing to help the struggling consumer who has too much credit card debt and not wanting to add fuel to the fire of already elevated asset prices. If they cut rates, we could see more inflation, which will put more pressure on those people who are already struggling. And all of this creates a serious recession risk. When consumers maxed out credit cards start defaulting, they stop spending. Consumer spending is 70% of GDP. If that cracks significantly, the AI stock rally won't save the economy.
One of our clients started with 0 audience. Now they're doing $100,000 months thanks to YouTube. And they're not alone. We've helped 3 businesses hit that level just by growing them a YouTube channel. Want to see how this could work for your business? Book a call with me below.